Rob Carnell from ING joins us on the phone line to try and understand the damage that the equity markets could see this morning. Rob, hi, morning. And firstly,
morning.
Do you think this is just strong talk that is transpiring between Trump as well as the Chinese premier, or do you think this is actually going to spell trade wars?
Good question. Who knows, really? But the thing, if you want to sort of hold out an optimistic view on this, it's that Trump tends to shout very loud and then not deliver all that much. So we saw this with the steel and aluminium tariffs. There was a lot of talk, and actually there aren't that many countries now, when you add it all up, who don't have an exemption now. So is this all part of his negotiating tactic? He's talked about trying to get $100 billion off the bilateral surplus with China, which stands at about $375 billion. If China comes back and says, look, okay, we'll buy a lot more of your liquefied natural gas, that'll go a long way to meeting that target. How about you lay off the tariffs? That might be one way out of this. But it's a very risky way to conduct trade policy.
So, Rob, what is it that we're staring at? A fresh wave of continuous selling, or just a knee-jerk reaction? Because a large part of the correction has already happened when, the tariffs were slapped on the steel sector.
Well, we'll know. I think it's a response to today's news and the further slightly sort of incremental increase in the protectionism, the trade war. I think if we get further overtures, if we get further retaliation to the retaliation, then I think markets might start to price in more than just response to the news, might start to take much more of a sort of risk-averse attitude to try and front-run the development of this. Because the plain and simple truth is that more trade is basically good for global growth, and the more of this sort of tariff behavior we see, the more likely it is that the global growth story, the synchronous global growth story, is going to get undermined.
There are two reasons why currently global markets are nervous. First, markets are worried about inflation and global growth, which could lead to an uptick in cost of capital. And second is trade war. Now, both these factors, Rob, I'm afraid they cannot really coexist. If indeed inflation and global growth is strong, that means the world will not have trade war. And if trade war is coming, that means inflation and global growth will come down, and central bankers are not likely to increase interest rates. So sometimes when I look at the data points, I personally get confused at what really is bothering markets.
Well, I don't agree with you on the inflation point. I don't think there's inflation anywhere, really. The only places you've got inflation are in economies where the currency is weak, and that's usually reflecting a poor balance of payment situation. Anywhere else where economies are broadly in balance or running slight surpluses, inflation is nowhere to be seen. So I take issue with your analysis there.
Thanks, Rob, for joining us and throwing light on what this tariff war is all about. And important point which Rob mentioned is that Trump tends to shout aloud but delivers less, and this seemed to be more of a negotiation tactic rather than any meaningful tariff war or trade war which would escalate further.